Hey everybody. So far my number one episode of the year is with Steve Kundert, Debt and Equity Advisor with CBRE. And I've got him back on the podcast today, and we're going to hear about what's going on in the debt and equity markets in 2023.
Listen, everybody, we all know that real estate is the most proven way to build wealth. But why isn't everyone wealthy from real estate then? It's hard to know where to start, and most of the education out there is just complete trash, and you end up investing your money on a series of courses instead of in real estate. That's not how this podcast works. We give you the blueprint to successful real estate investing and bring on guests actually willing to share their secrets. I started my real estate investing journey as a freshman in college when I bought my first duplex and have been in the trenches doing deals ever since. And today, I now own hundreds of millions of dollars of investment property. On this podcast, you will learn what you actually need to know to be a successful active or passive real estate investor. And we'll offer our takes on what's happening today so you can navigate this market and build wealth. I'm Drew Breneman, and this is the Breneman Blueprint.
All right, welcome back to another episode of the Breneman Blueprint. Have Steve Kundert, Debt and Equity Advisor with CBRE, on the podcast. I think if you saw my little intro video there, he's got the number one episode of 2023. So, but besides crushing my podcast, I mean, he's done billions of dollars of lending. So happy to have you back on. And I think with this episode, want to just kind of go maybe hear what's going on just with the debt and equity markets, and then maybe go kind of like lender type by lender type, just kind of slowly hear like what each one's doing and how how the year's going.
Yeah,
So,
no, it's a pleasure to be back on. I'm always excited to come do this, and there's been a lot of activity this year and a lot to talk about.
yeah, and I think if people haven't seen the other two episodes we did, maybe just do like a quick background on yourself. And
I'm a debt and equity intermediary. My title is a senior vice president with CBRE Debt and Structured Finance, and what that means is I'm a mortgage broker. So I place both debt and structured equity products on behalf of my clients, all third-party capital. We don't have any proprietary funds ourselves besides being an agency lender, and work the entire spectrum of capital and the entire capital stack. So happy to again be here and talk through what's going on.
awesome. Well, yeah, I think then why don't we just start? Actually, why don't we go with different order than maybe what we did on the first one? What would you say borrowers today should be thinking about, like, first and foremost?
I think the primary concern with borrowers right now are interest rates, right? So you look back on the date of our last discussion, and that was, I believe it was early March. And about a week and a half later was the banking crisis that we experienced. It was the second largest bank collapse since Lehman in 2008 with SVB, followed shortly by Signature and all the other middle market stress that we experienced. That really put the entire market into turmoil. So everything that we talked about in terms of actual interest rates and coupons during the last podcast, I think I even mentioned it in one of the comments, it became obsolete in a matter of weeks. You now fast forward to today and how that has filtered through the market and the lending environment, and it has been very significant. Because going into the last podcast, we had the discussion that there was a lot of capital allocated for commercial real estate in 2023, the same, if not more, than 2022. Because of the banking crisis, a lot of that liquidity, a lot of that allocation, especially from the banking community, seized up pretty tight. The middle market bank probably experienced the greatest pullback in liquidity because they were hoarding cash, not knowing ultimately what their exposure would be to everything that ultimately caused the problems with SVB and Signature. You had the larger money market banks that were already pulling back liquidity for smaller deals because of the amount of volume that they put into larger SASB deals that previously would have been CMBS last year. The local banks, ironically, have not been impacted all that much either back in 2022 or through the crisis. But because of that pullback in liquidity from the middle market banks, that created a pretty large vacuum of financing for that middle market investor. because banks were holding back their money for either their primary clients, or if they were extending new credit, they were looking for, in some cases, unrealistic depository requirements. I had one bank that quoted me, this was for when I was marketing a loan back in April for a relatively generic power center retail deal. They were looking for 10 to 15% of the loan amount in deposits. Now that's a large amount of money to bring over to a new bank. I mean, they're almost asking for their federal depository requirements to be fulfilled by that one borrower, and that's just not realistic.
Right.
So it was, whether you call it an attempt to be more aggressive in terms of trying to grab market share, or you call it an instance of quoting to not quote, whatever the reason, it was causing a big pullback in liquidity from that middle market banking.
Yeah, and I mean, and something else we had talked about is, rates shoot up, no one's paying off the loans. Like there's very few transactions, no one's refinancing unless they're forced to. So these banks are not getting payoffs. They're worried about if there's going to be a run on the bank, right? And everything seizes up. When you say middle market size, like what size are we talking?
You're looking, generically speaking, probably a $5 to $15 million, maybe $20 million loan amount. So it's those banks like put it in a Chicago vernacular, it's an Old National or a Wintrust of that ilk.
Because those are not small banks.
They're not.
They're not. Where I think most of the bank lending I've done has been borrowing, I should say, has been with banks of that size or quite a bit smaller. Mm-hmm. And even I know you were saying the smaller banks not impacted. What's interesting is, it won't be obvious to you and maybe not to the listener, but there's so much variation in what all these banks are doing, So as I started smiling, I say the small banks aren't impacted, but then yet some are quoting 8% right now on on loans, or what's your fixed rate, and it's pushing 7%, where it's almost like, are we quoting to not quote, or however you put it, where they'll still their originators are still sending out quotes, but it's not realistic,
right,
when you're competing with Fannie and Freddie option, that at the time was, it's in the 5%.
Yeah, and I think that middle market bank was impacted the greatest because they are big enough to have a sophisticated enough portfolio management and treasury department where they are diversifying their holdings into crypto, into a little bit more complicated CRE deals, into other deals that are just outside the purview of smaller local banks. If you stay to what which is what the smaller local banks do, you're in less trouble. But once you get out and start to get into the products that now have national and global economic tentacles, right? Something that happens over here is going to impact you here, and that's where they started to experience the hardships and then realize that there might be a liquidity problem.
Yeah, and were many banks in crypto? I guess I knew that Signature did something with crypto, but not.
I'm using that as an example.
Oh, okay, just the stuff that's not real estate or traditional lending. Right, yeah, and then SVB had so much concentration with these clients of theirs that had just so much money in the bank. Like Hulu had like $400 million in the bank.
Correct.
With them. Like that's not normal. But okay, well, yeah. So then I think let's just go kind of what each lender's doing. In today's times, what does it look like for pros and cons and kind of requirements and. Mm-hmm. I mean, rates change, but kind of generically, how does it work? So, I mean, where do you want to start?
So we can just go down the list of capital providers, and we'll try to tailor it a little bit to a multifamily focus. Although
we can do broader than that too, if you want. Like when we get to each.
So let's start with the agencies, because I think that's obviously the most prevalent source of capital for multifamily. And the agencies are still as liquid as they ever have been. The goal for allocation on the year has not changed. They're still quoting deals as aggressively as any lender in the market. There have been some changes to try to account for the turmoil in the interest rate market. For example, on the affordable program through Fannie Mae, they are now no longer offering a 35-year amortization. That's programmatically across the board. So in yesterday's world, if you have a transaction where the rent roll fulfills the affordability requirements, which is a percentage of AMI, and makes it a percentage of mission-driven deal, because at its core, the agencies that I've discussed before, their mission is to promote affordable housing.
And this is not just necessarily tax credit deals.
This does not have to be any contractual or programmatic rent control or rent limitation. This is just where is the rent roll snapshot in time relative to the larger market. So if you have a deal that is defined as affordable in yesterday's world, in addition to getting the discount in pricing, which can be every bit of 20 basis points off of conventional pricing, you also have the ability to size it to a 35-year sizing constant. So if you are looking to maximize your loan amount, it's going to be constrained by LTV, it's going to be constrained by loan to cost, it's going to be constrained by debt service coverage. Debt service coverage is relative to what your payment constant is, which gets back to your amortization. So on an affordable deal, again, in yesterday's world, you could size that to a 35-year schedule, which would make it a lower payment, higher loan amount. But now going forward, even for 100% mission-driven deals, they are eliminating that 35-year option. So that impacts it two ways. One, that impacts it as far as your sizing constant, as well as your actual payment coupon, or your payment constant. Because if you have an amortizing deal sized to a 35-year, again, not only is it going to size to a larger amount, but your annual and monthly payment will be lower. That's now 30 years across the board. So that is putting a little bit of strain on available capital for affordable deals. So you now couple that with where rates are, and generically right now, Fannie Mae rates are anywhere between 5 3/4 and 6 1/8 for conventional deal, full leverage type transactions, and on the affordable side, it's anywhere between 5. I'll say 5.5, 5.60 to 5 3/4. Now again, that's a snapshot in time today. Those spreads translate to somewhere around 150 to 160 for 150, 160 basis points for affordable deals, and anywhere from 175 to 200 for conventional deals. That hasn't moved all that much since both the last time we spoke, as well as going back even to probably our first podcast. What has changed is the index. So the payment coupon is a sum of the spread and the index. The index being the like maturity treasury for the duration of the loan. 5-year deal gets sized and priced over the 5-year treasury. 7-year deal likewise over the 7-year treasury. 10-year deal likewise over the 10-year treasury. You look at the 10-year treasury, which again, as of this morning, and it's important to keep an eye on that, given the durability of these podcasts on the internet. Yeah. But as of this morning, the 10-year treasury was yielding 4.05. That is up 20 basis points from last week. That's up about 50 basis points from our last discussion back in March. So now you filter that through all the iterations of the sizing constant. What that really means is a lower loan amount on the same NOI.
Yeah, and higher payment,
exactly,
or higher interest rate.
Yes,
same payment, I guess, if we're sizing a max debt cover. But it's interesting where I feel like really for the last 9 months, let's say, I mean, for the deals we've looked at, every financing strategy has just been Fannie conventional, or I guess some Freddie Mac,
Freddie
small
Mac as
balance.
well. Yes.
Well, it seemed like on the conventional side that every time we quoted something up, like Fannie was better.
As we've talked about before, that pricing pendulum kind of swings back and forth as far as who's more competitive. They're on the average about equal with each other. Snapshot in time, sometimes one is priced better than the other.
And then so it's kind of been an interesting, I guess, 9 months where it's like normally there's so many more options to look at, and then this is like, no, the banks, I mean, most of them, they're not really competitive right now compared to buying it with a Fannie loan, and then just, let's say you got to renovate it out of the equity, you like raise more equity and renovate, or do it from cash flow, but then focus on having the I'd rather have a 5.5% Fannie rate, fixed rate for 5 years, than a bank or debt fund loan at 7 or 8 to have a construction style loan.
Yeah, and that's a great segue to the next source of capital, being debt funds. And you look at the debt fund market, and it's almost non-existent right now. Not because there aren't lenders in the market, not because there isn't liquidity in that sector. It's just really the cost of that capital makes it almost prohibitive to use those types of lenders. So a debt fund, which we have used before on some of your transactions, can be a very useful tool for especially a heavy lift deal. They'll come in and potentially lend up to 80-85% of costs. They can give you future funding. They'll have an IO constant. Some programs do have a streamlined refinance into an agency. So there's a lot of positive attributes. But because they are floating rate debt, because they are priced over the term SOFR right now, with term SOFR being north of 5% on a core multifamily deal, which could be a spread of 3.5%, your coupon's in the 8s. And now you have something that's either higher leverage or requiring higher yield for whatever reason because of the risk profile. Now your pricing is 9%. You look at getting away from multifamily, you look at a debt fund on a retail deal or a land deal, you're into double digits. And that just, when you are trying to solve for an all-in return, that makes that source of capital extremely hard to navigate. On top of the interest rate protection that you have to purchase, which because of the yield curve can be anywhere between 2 and 4 points of the loan amount right now. On top of the regular transaction costs, because most debt funds of size are a securitized product. They are securitizing that into a CLO, and because of the exit fee. So you typically have an entrance fee and an exit fee. Entrance of 1%, and 1% of loan amount. Exit fee of anywhere between nothing to 25 basis points to 50 basis points of the loan amount. You add all of that together, those are significant transaction costs that now you have to build into the overall project cost, and it makes things very hard. And you look at the overall securitized market, and the overall securitized market, this includes CLO, this includes CMBS, this includes agency MBS. It is at a 12-year low in terms of volume for the first half of the year. The first half of 2023, it was, I believe it was about $41 billion of total securitizations. Again, that's across all securitized platforms. That is down 70% over the same time last year. And again, a 12-year low. I think that is because of not only the CMBS market, which we can touch on in a minute here, but now you look at, again, everything we just talked about regarding the debt fund market. That is putting a big strain on that source of capital.
Yeah, it makes sense to me. I mean, I don't, at least for when Fannie and Freddie are an option, it'd be very rare someone want to use a debt fund now in a multifamily deal. Mm-hmm. I could see it where, sure, if you have a hotel or something, an office building where the cap rate's going to be higher and there's less, and the agencies aren't an option, I would imagine most of that 41 or whatever billion that was done, it wasn't a lot of multifamily.
No, it wasn't actually that's another great segue. So if you look at the private label CMBS, so non-agency MBS, non-CLO, so that when you say CMBS, that's what most people think about is the Goldmans and the Cities, that type of CMBS paper. It was about 3.5% of total volume this year has been multifamily deals. Of the it's about $16.5 billion private label so far this year. So 3.5% of that has been multifamily. That's nothing.
Yeah, I'm not surprised. I saw actually someone posted who this person invests in industrial property, and I didn't want to bother pointing this out because I like him, but he posted a chart of CMBS delinquencies by product type and how industrial was the best, and multifamily was above it. And I was gonna reply like, who on earth is using CMBS for multifamily? Like,
you don't. I mean, not only does the agencies provide enough liquidity and in a superior product to CMBS because of the way that they can size their loans, but not only the pricing of CMBS is higher, even on core product, multifamily or industrial, but also the rating agencies, they hit the sizing for multifamily exceptionally hard. So a loan that would potentially size, and I'm using generic numbers, but potentially size for 75% leverage through one of the agencies is coming up at the high 60s or 70% for CMBS. It just doesn't make any sense.
Yeah, we've talked about that where it's the rate's worse, the proceeds are less, the service is worse, it's more expensive. It's like what is there to like for
exactly?
Yeah,
right.
but
Exactly.
if you're doing the other product types and that's not an option, this is one of the reasons I like multifamily is you always have this consistent, whatever it is, combined 150 billion a year of lending from the agencies. I never remember the exact number, so I usually just round it off, and then I go, it's 50 billion or more from each is what I say, because it's like 70 or 80 each or something, and I don't want to be wrong, but also I don't want to be like 73.5 billion is the cap this year or whatever.
Well, I mean, as long as we're talking about securitized products, I think it is interesting to note, as it ties back to the agencies, is how, because it is all tied together, right? The American and global economy, it all interacts with everything else, which makes it both fascinating and frustrating that one sector can impact the other as much as it does. But you look at spreads in both CMBS, Fannie Mae, and Freddie Mac K-series securitized deals, and spreads did blow out pretty significantly in the second quarter after the banking crisis, because one of the largest, if not the largest, buyer of CMBS paper and agency paper and one-off Fannie Mae securitizations is regional banks. So now once they started pulling back on their liquidity, hoarding cash, that left a big vacuum for investors on the back end. So what you are left now is the second largest buyer, which is hedge funds. Hedge funds inherently need a higher cost of capital. So as the traders went out to try to place that paper, smaller buyer pool, obviously you need to have higher yields, lower cost. And that's what caused the spreads to go out. Now that is starting to settle down a little bit in the market today, which is why the spreads. So Fannie Mae generic spreads have come in probably about 15 bips over the last 30, 45 days because you have more buyers into the market. But it will be interesting to continue to monitor what that market looks like, because it all is intertwined.
Yeah, it's interesting. Everything's always changing, and I mean, even a little bit ago, we were talking about how the debt fund spread blew out, but now sounds like those are back to like normal. I mean, the rates are still, not great because of where SOFR is at, but for a minute, it was like the debt funds are getting their warehouse lines pulled, so to still make whatever return they need to make for the fund, 9%, 10%. I'm not sure what they're trying to make, but they need to have a big enough spread on the smaller amount of loans now. So now it's SOFR +5 for a little bit. I mean, when did that kind of go back to the like a 300 something spread?
That started happening over the summer, again, as the banking crisis subsided, because you're exactly right, as they have their warehouse lines, which the warehouse lines primarily came from the banks, especially the larger money center banks. They had to price their capital accordingly to either hoard cash or get enough yield to put it out the door. The cost of those warehouse lines went up, and then in turn, to get the yield that the debt funds needed, they in turn had to increase their spreads. Now there were a couple of debt funds that fund 100% off their balance sheet, and if you're funding an unlevered loan, it has to be, in today's world, 9.5%, 10% to make that work, because that's more or less what they are sizing to on a levered basis when they're levering up their position. But because of the cost of capital coming in from the warehouse lines, those spreads did come in. So you are seeing core multifamily, core industrial debt fund spreads, in some cases dropping back below 300, but firmly in the 300s for modest deals, and back into the 400s for higher yielding deals, which is probably in about 150 basis points from our last discussion.
We're back to normal, but I mean, it's a moot point right now, most of where SOFR's at.
Index, right?
Yeah, if you're in multifamily. But then, and you have clients that are doing really every product type. I mean, it sounds like. So what are people doing for financing on, the commercial deals? So industrial, retail, hotels, like what does that look like today?
For core industrial, again, core multifamily, low leverage multifamily, the life companies are still dominating that market. We are seeing spreads for low leverage core deals in the 140s, in some cases 150s over the Treasury, which is a mid fives coupon. Again, in today's world, in yesterday's world, it was touching 5 or sub 5 going back 30 days. And on retail, that could be a discussion for a whole other podcast, but generically, grocery anchored deals are still getting bid pretty aggressively. I have a quote in hand on a jewel anchored deal here in Chicago, well located, inner ring neighborhood, that was priced at 155 over for a 55% loan. Again, that's a life company loan with prepayment flexibility. Loan amount on that it's smaller in size. It's a mid-teens loan amount. Once you get away from grocery anchored into the power centers, you start to drop off a little bit in terms of available capital. Larger power centers, secondary locations, it's pretty much CMBS only, which is really putting a pause in the investment sales market for larger format retail, because given where spreads are in the CMBS market, given where the index is in the CMBS market, that could be every bit of a 7% loan coupon. So what that's doing is that's pushing up the cap rates at which these are trading, into some cases the 9, as investors look to get the delta in yield between their cost of capital and their return. Hotels, I'm not very active in that sector, although I do know there is, especially for well-located, larger full-service hotels, there does seem to be some liquidity in the market. Self-storage continues to be a very active product type. Life companies are continuing to have interest in that. And, again, industrial is as strong, continues to be as strong as it ever has been, with multiple lenders chasing deals in the mid 100 type spreads.
And it has the lowest CMBS delinquency.
Yes, it does.
Of all CMBS loans. So, that makes sense, because the thing what's interesting when you're talking about the retail power centers, I think we had talked about this deal when it was for sale. Actually, I know we did, because you had asked me something about it, but a deal in Minnesota that, not to name it, but where it would have been like a trophy, 10 years ago, like a 6 cap, kind of thing, when interest rates were in the 6s, where it would have been, a million people all over it. And now it's like, it's like the poster child of like businesses going out. It's like we got the Toys R Us, they're gone. Then we got like down the line, and it's in one of the best suburbs, right, a great location. And it's like, wasn't even selling at like a 9 cap. So it's kind of wild to see what's, like how bifurcated retail is, and like then you have whatever, the Chick-fil-A on the corner selling probably for a 3 cap. So
the single tenant net lease business continues to be extremely hot, especially for trade buyers who are looking to, and that's really more a preservation of wealth rather than creation of wealth type approach. So you have, to your point, a Chick-fil-A or another one of these STNL deals that are still trading in the in some cases high 3s, mid 4s. There is a transaction to which I am staple on the investment sales side here in Chicago. Single tenant deal, technology company, very high profile. Everyone knows the deal if you look for it. That it's going to probably trade at about a 4.5 cap. And this is in the Lincoln Park neighborhood. Now, if you look to try to lever that, you can't do it, because there is no debt low enough to make positive leverage. So who's the buyer profile in that? It's a trade buyer, typically coming off one of the coasts that have sold something and now just looking to deploy into a 4.5 yield for however long they hold it. If it's a long-term generational type client, they might just hold it for a while. Otherwise, they might hang on to it and then resell into a lower interest rate environment in the future. But that market continues to be strong. But you're getting back to the multi-tenant retail. I'm not quite as draconian as some people are on the product type. I tend to like retail quite a bit. Grocery anchored, there's always a need for grocers. Wherever you are in the country, regardless of the market, there is a need for grocery. Now, is there capital that'll chase it into a tertiary or sub-tertiary location in the middle of the Midwest or Southeast? Well, no, but there are still recourse lenders that will lend in that environment, and you can still achieve positive leverage. And then for power centers, I think we are in an environment today where the tenants that should still be in business are in business. The tenants that should not be, we have seen largely a lot of them go to the wayside, whether that be the Bed Baths of the world or some of the office supply companies. The tenants that remain tend to be doing fairly well. And because of the yield possibility, where else can you buy a well-known, I don't want to say trophy asset, but I would say acknowledged asset, a large visible asset with a yield on 9% unlevered. You can now lever that even with 7% CMBS debt. You could lever that to a 16, 17% return. Compare that to multifamily at 10% or 12% or whatever the number is. Now, that's not to take away anything from the attributes of multifamily in terms of being able to raise rents monthly or to annually and everything associated with why people like multifamily, but it's not a 17% levered return.
Yeah, and it's interesting on a podcast that I did with Tyler Haig, kind of around the same time we did our last one, and he was about to say and he's a multifamily broker, and he was like, what product type I think is actually going to do him pretty well and surprising, and I don't want to ruin his point, but I think on that one I did, and I was like retail, because I still have 4 retail deals. I know we haven't lost any tenants for the small shop retail. Rents have been growing, and the cap rates have always been higher. These are smaller deals. We've been doing these, bank loans with swaps, and so we have all of our deals. 2 are in the 5% from 2018, so those we were kicking ourselves for getting, and all the other ones are 3.1% 10-year fixed and 3.28. The other. And so that adds up to one of those was industrial. So I think we get 4 or 5 retail deals. I have to count them up, but they so those, my partner on those always is these are my favorite deals.
The well-located strip center deals are very liquid assets. So if you look at the hierarchy of retail, it's in terms of lender preference, it's grocery anchored, it's well-located strip retail, and then it's your power centers. And I don't think my arm is long enough to show you where malls rank.
Yeah,
it's much below that. But just a couple of data points. And again, this is a snapshot in time. But grocery anchor deal here in Chicago, 155 spread, 55%. I have a power center in Lake County, Northern Illinois, that we have life company interest at a 250 spread. We have bank interest, quoting coupon at 6 1/8, 6% for the right sponsor. I have a power center in suburban Cleveland that the coupon is going to be plus or minus right around 6 3/4. I have a grocery anchor deal in Nashville where the coupon, it's based off of a 175 spread. So you now filter that through the cap rate at which they're being acquired, and that's positive leverage.
Yeah, no, that's interesting to hear. Yeah, and the part of retail that I like, where you had your arm there, is not the single tenant. Yeah, the yield's too low. But then you get into this multi-tenant small shop space, and then the cap rates are higher because it's not single tenant, which from a risk standpoint doesn't make any sense.
Right.
But hey, that sounds great to me. Higher cap rate for diversified rent roll, I'll take it. And so I've liked those deals, and I think it makes a lot of sense. And you can combine that with a value add strategy and know, hey, this tenant's below market, just kind of wait for their renewal, or if they go out of business, it's actually will be positive for the building. Yeah, the only thing that I'd say with talking about the power centers is that I feel like that's a market that's in decline. So I know that sounds great. It's a 9 cap right now. What cap rate you selling that at, and are your rents going to be higher or lower when you sell?
And it's where are rents today versus where are rents going to be tomorrow, or even what our rents are in place versus where our rents today, and the co-tenancy, because especially with these larger centers, some of them shadow anchored, you have co-tenancies tied back in some cases to stores you have no control.
Yeah, and to unpack that, these co-tenancy clauses in these leases, it'll say if to just name a name, let's say you're in a shopping center and the main draw is Walmart or Costco, it'll say, or the grocery store, it'll say in the lease for the other tenants, if this grocery store, if Costco closes, we get to pay 50% of our rent or something like that. So you have this whole thing can just kind of implode quickly, and then couple that with a bank loan with a debt service coverage
that's
covenant.
Correct. Yeah.
And I've seen that firsthand, not on a deal of mine, but just where plenty of times people explaining, here's how this thing went wrong, and it's
those
just
dominoes start to fall awfully fast.
A parade of horribles, things cascading down. Where at least in multifamily, your rents can drop, but there's no debt service coverage covenants in the agency loans. There's not. It's you can sleep at night a little better.
So. Plus, you have the ability, as mentioned, to raise rents annually. So I'm not advocating, if you are a multifamily investor at your core, to jump on the retail ship. I was just using that example of where yields are still possible in this market. Yeah,
and I think it was helpful for me to work on these other product types and to understand why I liked multifamily. And there's pluses and minuses to each. Mm-hmm. Obviously, if multifamily is going to be the most liquid and safest, I guess debatable, or what time period you're looking at multifamily compared to industrial, but they're right there with each other. Like, yeah, the returns aren't just for your generic stabilized deal. It's not going to be as high as something that's more risky,
mm-hmm.
But yeah, it's interesting to think about and talk about. And I think that's one area where, like, it kind of is going under the radar, where to a lot of people, they're just retail and office are not investable, but there are parts that are, to kind of what we've talked about, retail deals that make sense. And I haven't looked into it much, but there's probably office deals that make sense to do, where I saw an article that I didn't read, but just saw the headline, and it was like 60% of all office vacancy, some percent that was very high, is in 10% of the buildings.
Mm-hmm.
So then if you were like, okay, if you got rid of that, it's like this market maybe doesn't have every tailwind in the world behind it, like self-storage or a multifamily or industrial, but maybe is more neutral. It's not a complete disaster.
I think the office market is an extreme example, but it's not unlike the opportunity in every sector right now. Are there fundamentally good office deals right now? Yes, there are. That have some vacancy? Yes, there are. Are there still some bad office deals that probably no one should touch? Unfortunately, yeah, there are. But you look at that opportunity for an investor to come in and acquire these, again, fundamentally sound, well-located deals at an attractive basis. That is the opportunity that we're seeing across all property types, multifamily included, where you have, because of the disconnect right now in cost of capital and market cap rates, there you can, and this isn't unequivocal across the board, but there is opportunity to pick up multifamily, to pick up retail, to pick up office, probably not industrial, but to pick up a majority of assets, or an opportunity to pick up some assets at a basis play, given where interest rates are.
Yeah.
Will you have negative leverage for a couple of years? Yeah, you might. But if you are not, and that's the difference between being an entrepreneurial investor with patient equity versus a fund where you have to make essentially a current return. If you are an entrepreneurial investor, you have patient equity, whether it's yours or someone else's. You can almost look at some of these acquisitions as a basis play, knowing that you might have higher interest rates today, negative leverage for a couple of years, but then you refinance. But now you're into a deal at a basis that's 70% of what it could be once rates return. Now, again, if you're a fund investor or you're using a fund structure, you need to make those payments on a regular basis, or else you don't get to the next fund. That won't work for you in that scenario. So in that case, the opportunity is not as prevalent. But I look in times like this of disruption. There's certainly going to be pain, but there's also still a lot of opportunity. And I think that is, for the astute investor, the time to be going in and looking on the long term. You can't look at your return on a 3-year IRR or 5-year IRR basis because of that negative leverage. It's going to kill it. But if you can buy a multifamily deal that is in a normal market, whatever it is, a 300 a unit deal, and you're able to buy it for $225 a unit, well, now once that market stabilizes, that's where fortunes are made.
Yeah, and it's interesting. I know, obviously prices dropped, but the stuff that does come on the market in multifamily, there's still so much activity on it. I mean, of the nice stuff where we, a deal we put an LOI in Dallas, it was widely marketed. It's not normally how we'd buy, but there were 29 offers on it. Mm-hmm. So while that seller was under some distress, if you get 29 offers, the price reflects no distress. They made a great market, and it's going at a big price. So I do agree with you where, if you can buy something for 30% less than it was 2 seconds ago, like that should just make sense already. But part of the reason the prices were where they were is because everything was growing so fast, then you're assuming there's growth.
Well, you do have those fund investors that have a mandate to get money out the door. So they in some cases are just looking to buy product. Sometimes, yield be damned as far as what's available out there, when that's pushing up the price artificially high versus where it should be.
Interesting. Yeah, so that's where I've still been sort of waiting for, like, hey, here's the distressed price. I mean, it's because also the thing that's happened is if you had to sell a normal amount of properties in a year, prices would be down 20+%. But what's happening is transaction volume's down, depending on where it is, 50 to 80%. So then there's less buyers as well, but there's still a lot of buyers on very few deals, which then keeps the pricing for what does sell has been keeping it pretty well supported. Yeah. So that's why we haven't bought anything in a year, Well,
and it's, and again, we've talked about this before. It's that discipline that ultimately your investors appreciate, to know what you're good at, to know what deals you should be chasing. And that's the highlights you put on your brochure, right? It's not how many deals have you bought. This is the return at which we bought them. I mean, anyone can go out and pay X for a deal, but if that X is 50% above where it should be, and that's nothing to brag about.
Right. Yeah, you just paid the most. Yep. Because we've had a lot of new investors sign up in the last year, and nothing to get in front of them. So it's been frustrating, obviously, but also too, like, there's no point in my mind of like pushing deals. Mm-hmm. Then they're a poor return for everybody. You're even selfishly, it's like you're kind of working for nearly for free if you don't hit your promote. And these things are a lot of work and risk and too. So I have started telling people, like, be really careful with what if there's other deals out there to invest in, because too right now, if you like, hey, we need to bring in money, like, you could push a deal like another sponsor or somebody, and then like this was the highest bidder of the 29 bids, and now that's the deal you're investing in. Whereas you talked to me and I was like, hey, I feel like there's going to be, the deals will really start flowing in 3 months, so we don't have anything. Mm-hmm. And not that we're not looking, and I don't know it'll be in 3 months, but at least right now I don't have anything for you. And then I worry a little bit for that investor, like that passive investor. Then they go to the next place that, hey, we've got 3 deals right now. And it's right, because you were the highest bidder of the 30 on each one, and you're assuming, your numbers assume big rent growth, or like the base case has refi and pulling money out or lower rate, which I think that'll happen. But I don't want that in my base case to assume rates go down to 4.5. Right. Like if someone said, what do you think is going to happen in the next couple of years? I think most of these deals, you buy them now, it's just like you said, a basis play. You're buying it for so much less than before. Your returns end up looking great when you're done, but it'll surprise you how it'll play out. Rents, maybe they don't grow at all for 2 years. Then they explode the last half of your ownership period. At some point in the next year or two, you refi at 4.5% interest and pull money out and return it. And so I think it'll go well. It's interesting. You start underwriting all those scenarios in it, and it's like the deal feels like it's juiced, but I think that can happen. And that's what happened to the deals we bought in 2009 and 10 and 11, where we bought them because there was a lot of cash flow. Right. And now there's not even that to hang your hat on now, because that was our thesis, was like, at least we can buy these And even if the market's always bad, at least we're cash flowing double digits. So don't overthink it. And now instead it's like the cash flow, yeah, it's like what treasuries make, but there's the upside and you're paying the loan down. It's not as enticing, but I think it'll probably work out about the same way. So then for transitional properties, then let's talk about that. So when we do, we're in order to hit any decent return now, you have to be doing value add. If you want to place money of your own or something, I mean, stabilized properties, that's great. Or what we just talked about, perfect for a refi. Let's say you're buying a value add deal. Maybe let's do multifamily last to switch it up. If you're buying a value add commercial deal, what would we be looking at for debt?
Bank. I mean, it's, and that's not to be a flippant answer, but for retail or office, I mean, I don't want to say there is no value add program, but there's not. I mean, vacancy in place for retail is usually there for a reason. Vacancy in place for office is there for a reason, unless it's extraordinarily located, and for some reason the vacancy was caused by, I don't even know the reason that would draw institutional capital. It's going to be, for the most part, recourse bank lending. They're just even with a call it a retail or an office deal where you have some near-term roll, structuring good news dollars for those transactions are extremely tough, because any additional dollar advanced isn't necessarily accretive to NOI. You are just replacing cash flow. So your debt yield stays the same, your debt cover stays the same. So you're really looking at a bank that knows you as a sponsor and can ride with you.
I mean, that's how our commercial deals that they're not value add are financed. It's all bank. It's all recourse. The loan to values are low, so I don't mind being on those. But yeah, that's all it is. And I was just thinking you'd say debt fund though too. I mean, they just mostly chase after multifamily then, or what?
Short answer is yes, they do.
They do what?
To chase after
okay.
multifamily. In some cases, some industrial, but the industrial market continues to be so hot that even an industrial deal with vacancy is almost priced as a stabilized deal because of the leasing velocity that's available. So in terms of what a debt fund is doing, it's almost stressed exclusively multifamily.
It's interesting. I didn't know that. I figured they were doing all sorts of other product types actually. Never looked at it.
In terms of the major types, not really. So I mean, think about a retail deal with vacancy. If you are sitting on vacancy for a while, there's a reason why that site hasn't been released. If you're sitting on vacancy that you can release, investors will release it themselves, and then realize that in terms of a lower cap rate. It's not like you have. And again, this gets back to the attractiveness of a multifamily deal. You don't have a loss to lease consideration. In some cases you do, but you can't realize it as quickly. You can't really increase rents by renovation of the property, or you can't go add a pool to a shopping center and all of a sudden raise rents $50. You can't give them a washer and dryer and raise rents $50. So you don't have that value add opportunity that you would with multifamily. And in terms of pricing that risk, the debt funds are more inclined to hold on to their capital for multifamily deals versus going into retail.
Yeah, makes sense. Okay, that's interesting. Yeah, I thought there were more options. I mean, we went the bank route just because the rates have always been the best, and then it's basically been free to work with this bank in terms of origination costs. Where we're going direct and there's no origination. They're just waiving everything. So, but okay, nice. Yeah, then I think for then transitional multifamily, so on the bank rates, we ever get into what bank interest rates are today?
High fives, low sixes right now.
Okay. For stabilized deals, did you say? Or?
For both. They tend to price their money about the same. It really just depends on how you structure it. True transitional deals might be SOFR swap based, so you're looking at maybe a 250 type spread. Given where SOFR swaps are, you're still wind up in that same kind of cost of capital range. but it's going to be really close to being on top of each other in terms of pricing.
And then are most banks doing their fixed rate stuff with swaps then? Or
Correct.
What are they? Okay.
Yes, there's a few exceptions. Credit unions often price on a fixed rate base almost exclusively, and they'll price it on a coupon, but it's really based off of over the treasury. It's when you get into more regional and money center banks where you actually start seeing the SOFR swap based type lending.
Okay. And then so transitional multifamily, what are we looking at?
As discussed a little bit ago, the debt fund market is still very active. We are seeing in some cases spreads in the 200s up through the mid 300s for that. The all-in coupon set aside in terms of it being 8-9%. But what that just means is you build that into the project cost, and if ultimately the returns make sense, then that's just a cost of doing business. You build that into your return model and see if it makes sense because of the leverage capability, and you can still size down to a 5, in some cases below debt yield, and stabilize out at a 7 debt yield. That money is otherwise hard to find. The banks typically won't go that low in debt yield. They'd be looking for some level of coverage. You have covenants you have to deal with once you get further on in the hold period. So the debt funds still continue to be the most active for transitional deals. And because of, again, the prevalence of bridge to agency type transactions on multifamily deals, especially, we are usually able to negotiate that exit fee down to a relatively small amount, what call it 25 bips, have it waved together, whatever it is. But that does help and provides a streamlined access into the agency market.
And so debt funds, I guess I haven't had a debt fund thing sized up in a long time. They're sizing down to a 5 debt yield at times?
Ultimately, they're sizing to what the exit looks like. And if the assumptions to get to that exit are reasonable, they can size as low as 5, or in some cases, theoretically, they could size to a 0 debt yield. I mean, you could have a completely vacant building if it is well located. If there's data to support that you can lease it up, there is theoretically lenders for that deal. Typically, we don't see that very often, but that can happen. So again, how that exit looks, the reality of the assumptions to get there, that's the biggest driver.
How are they sizing the exit then?
They'll be sized into typically an agency exit. So they're making some interest rate assumptions as far as where rates will be, what coverage will be, and then in terms of debt yield, a stabilized debt yield of plus or minus 7.5 in today's market. Although again, in today's market, we're seeing less sizing to debt yield and more of what coverage might be.
When stabilized,
when
refi.
stabilized, typically on a non-trended basis with rents. Non-trended mean that what are rents today on a stabilized unit, and moving forward, the entire complex rented at those levels in 2-3 years, whenever that work is done. Trended being if you have 2.5-5% rent growth annually, they're not typically going to give you the benefit of that year over year rent growth. They're going to look at in place on the assumption. And this is to keep things a little bit more conservative, on the assumption that you aren't able to achieve those.
Right. And yeah, that's makes sense to me why they would do that. I mean, that's when you're a lender, it's glass half full usually.
Exactly right.
half empty. Sorry.
Right.
And they and the way I like to explain untrended is Evan, who works here, explained it as if you could just snap your fingers and you could just reset it all of today's prices.
Yes.
It's like, oh, it's a faster way, because I did it the same way that you do, where it's okay, it's growing, so it's actually in the future, but you don't grow the costs or the rents. It's in today's prices, but it's at the end of the loan, and it's the snap your fingers I liked. So
yep.
Feel free.
But why use one word when you can use 3?
Yeah,
that doesn't fill up time on a podcast.
Yeah,
does
that's
it?
right. So, but yeah, I think then maybe then the equity that you do, it's more would be helping folks find like pref equity. Why don't you tell us a little bit about that?
Yeah, so if the last podcast we talked a lot about that, given the the sizing disconnect of in-place loans today relative to what a new loan might look like. Because rates are higher, loans are not sizing to the same level as they were before. So in some cases, you would have a loan that, just call it generically, on a $10 million deal, the in-place loan amount is $6.5 million. It sizes based on rate to $6 million today. Value is still there. There's still real equity in those transactions. So the borrower doesn't want to walk away from the deal, nor do they potentially want to sell, because that sizing constraint, why we're coming up with that $6 million, is because of interest rates. We are in a hopefully artificially high interest rate environment today. You fast forward a year, it might be lower. He can refinance out at that point or sell at that point and realize all of his equity. So what do we do for that $500,000? We go out and find pref equity. There's a number of funds that have been raised specifically to come in and provide pref equity being the slug of capital between senior debt and common equity or sponsorship equity. That is sometimes structured as a coupon, sometimes structured as an overall return. But what that does is that it gives the lender comfort, because you have a new investor coming in, typically of an institutional or institutional adjacent profile, that will signify to them that there is wherewithal behind the equity if something should continue to go wrong. And the sponsor likes it because they are now paying a set rate. They're able to hold on to their deal. If things right size, they can pay them off and still hold on to their asset and realize their entire equity. Pref equity likes it because they're getting a set return, and they now have a path to ownership at a reduced basis should things continue to go wrong. So you have pref equity will invest in a deal that they want to own. The common equity wants to bring in pref equity because they don't want to lose a deal they want to own. And the lender is happy because they don't want to own it, and they know that these other guys will now step in and keep things from going wrong.
And what's the range of rates you're seeing?
10, 12% on a coupon basis, probably on an IRR basis. It's probably low double digits, somewhere in there. And that can be, it's typically more on a coupon basis because that means that the deal is still performing. It's just an interest rate issue. If you now have to structure the pref equity in terms of a cumulative return situation, that means there's no cash flow or stunted cash flow. And now you get into a little bit more complicated structure as far as how that looks.
So most of the pref equity you're seeing, it's a fully current pay?
Most of the funds are set up in that situation, yes. Not to say that's all of them, but that is how most of them are structured right now.
That's interesting, because I would think a very common scenario to bring in pref would be, okay, I was in this deal, I had a debt fund loan, I had a great interest rate cap, so I was paying like the equivalent of 5% interest. Now my new loan is being sized by, it's an agency loan, the rate's in the high fives, but it's being sized more conservatively than the debt funds were when everything was so hot. So now I need to add money. But it's like...
Yeah, I guess I should clarify that the coupon is more for stabilized deals that are facing a refinance hurdle. If you are in a lease-up transaction that you may not have full cash flow, in that case, it's not going to be current because there is going to be no cash flow. And so in that case, you would structure to an overall return, not an in-place.
But even actually where I was going with the scenario, it is stabilized now. But you're rolling off this great bank loan or debt fund loan where you had either a cap in place or something, where now you're rolling into a higher interest rate thing that's also being sized more conservatively, which means you need to add money. Mm-hmm. Now you don't have the money to add. You don't want to sell when prices are low. You bring in the pref. So I was thinking most of the pref was accruing. It's not something we've needed to do, so I haven't looked into it. But I thought it was more because like that borrower, they don't have a lot of room to pay out any money on pref because they already got it sized at a pretty tight debt cover. So I guess they do have the extra 20%, 25% of both.
Yeah, it's going to be deal dependent as is everything. If your coverage is sub 1.0 or 1.0, obviously you'd have to that's going to be a different scenario. It really is depending on where you are in the cycle of that deal and how constrained you are in that refinance.
Yeah, and I guess actually it's only I'm thinking, okay, if the deal after your refi might be the cash on all the equity would be like 5%, then how do you pay 12? But actually that's just on a small sliver of all the equity, just what's being added. So
correct. So in our scenario earlier, that was for only $500,000 of the $3.5 million of equity.
Okay, so yeah, then a lot of the cash flow is going to the interest on this $500,000.
It is, but it allows the common equity or the sponsor to maintain ownership over the deal.
Yeah. Okay. No, that makes sense. I was actually just wanted to unpack that because like I said, we haven't done any pref, so I just assumed it was more a scenario where, yeah, we want to keep it, but the deal's not going amazing. So we also don't have the cash to pay 12% interest, obviously. So we need to do like 6 now and 6 accruing or something. So but then that doesn't sound as good for the pref lender. Then it's like you're getting paid just like a senior note rate and then like more on the back end. Okay. No, I got it. I think, I guess maybe let's wrap up. But one thing that you had have talked to me a lot about over the years was, different, let's say, tips when financing. Like one of them is like matching your loan up with your business plan. I mean, you want to talk about that for a minute? Anything else that you think would be important? And then let's get right on.
Yeah. So because of the yield curve, because of where interest rates are today, a lot of my clients are understandably pursuing shorter term money. Now, the lending community also understandably has a glut of longer term money they are trying to get out the door because of if you can lock in a 10-year deal from a lender perspective at today's rates, obviously that's longer yield for a longer amount of time, or a higher yield for a longer amount of time. So what we are seeing is a lot of 7-year deals, a lot of 10-year deals with prepayment flexibility. Now, prepayment flexibility, if you look at what that means is, let's call it on a 7-year deal, it might be a yield maintenance for 2 and then a 5, 4, 3, 2, 1 step down, so that that number is a percentage of the outstanding loan amount. If you pay off in year 3, it's 5%. If you pay off in year 7, it's 1%. You can buy that flexibility, especially from the life companies, for a relatively inexpensive amount of money. Call it 10 to 15 basis points added to the spread. Now, lenders, knowing that, are also pricing in terms of spread, and then also because of where the underlying index is, we're still inverted in our cost of capital. 5-year money right now is typically more expensive than 10-year money, even at the same spread, because of the virtue of the inverted yield curve. But to your point of what should borrowers be considering is one, what is the goal for the asset? Is this a long-term generational asset, in which case maybe we should put longer-term money on it? Or is this a transitional deal where you're going to be doing some work and you may want to get out in 5 years? If you want to get out in 5 years, maybe you can tolerate a slightly higher interest rate, especially if you're going to be creating additional NOI during that hold period. So it's that's certainly one factor that you want to pay attention to. You want to look at the duration of that loan, not only in the context of that particular transaction, but also your other deals. Do you want all your deals maturing in 7 years? Well, no, you don't, because now if the world gets even worse than it is today, now you're faced with a whole wall of refinances. So we want to look at staggering those maturities. Now, if 3, 5, 7, 10, whatever the case may be. And then as you prepare to go out and look at a refinance, especially if it is in the future, 6, 12 months, take a look at your expenses. Make sure that you are managing those expenses very, very carefully, that you are scrubbing the statements that ultimately will show up in the lender's hands, because particularly if you have a loan in place and you have to just submit your annual financials, sometimes you just press the button, spit it out of the accounting software, and hand it over. And that's fine for the in-place lender. But a new lender will look at that and say, well, maybe your payroll's up too high. Well, okay, well, we had someone come on a contract basis. That's not normalized. We should pull that out. Maybe R&M is too high. Well, we had a unusually high snowplow, so that's something we should pull out. Take a look at those expenses. Make sure you're out in front of what those statements look like, so that when it comes time to refinance, they are already clean. You're not have to go back and recheck everything, because the cleaner the expenses, not only will there be less scrutiny from the lenders, but higher NOI, more loan proceeds. In addition to maintaining, and this is something I think that's good practice for everybody, probably at least on a quarterly basis, make sure that your personal financial statement, your REO schedule is up to date, and you're maintaining an accurate depiction of what your overall portfolio looks like. Again, just less scrutiny from the lenders later, and less work that you have to do once you actually do go out and try to find that loan.
Sounds great. And then too, I think just kind of to add with the maturity conversation, a lot of these lenders, so Freddie, SBL, Chase comes to mind, where they have a fixed rate term in the loan, but then a floating rate period that goes on for a long time. I think Freddie, SBL, most of those loans they were doing, if it was a 5-year fix, then there'd be like a 15-year floating rate period. Mm-hmm. Same thing with Chase. I think it was you'd know better than me, but for a whole 30-year period where it started floating. So I think if, that, like, think of that as a positive, like those kind of loans where it's, you have a lot more optionality on when you need to refi. Because one thing that we noticed in some of our deals, and you had mentioned you had just advised a client about this just right before we started recording, but let's say you have a loan that's maturing in the next year, and then with this Freddie SBL program, which is what it was, then it goes floating rate, but it doesn't just snap your fingers, as we say, go right to the new rate. With it can only go up by a certain amount initially, and then it readjusts in 6 months. So if rates stayed where they were before it gets sort of where the rate's really painful, I mean, it might be a year and a half, take 3 adjustments. So that loan that, is coming due next year, it really is like, you don't have to do anything with it, for 2-3 years. Like, take your time on refinancing, like those kind of loans, I'd say. Because obviously if you have a hard maturity date, then no, like, this doesn't apply. But a lot of people took those loans, I'd imagine, thinking like, well, I'll refi before the fixed rate period's even done. This is only what I do. And now, you'd be like me, and you're actually reading this. How does this adjustable period work that I've never gone in? And you're like, oh, it only can go up by this much in the first adjustment period. Well, that won't be so bad. My rate's at like 4 right now. Right. And so then it'll go to, I don't have in front of me, whatever the most it can go up. So that's not so bad. Then it goes, up again in 6 months. But by then, maybe rates have fallen. So anyways, just to add on that, where definitely want to stagger your maturities, and then if you can have that floating rate tail on a loan product, that's the way to go. And
talk to your mortgage broker. If you have a qualified, trustworthy mortgage broker, they will advise you on what is the best path forward. They will advise you that if you do have a Freddie Mac small balance loan that's reaching maturity right now, and it will only roll up 100 basis points every 6 months, they will tell you, don't do a thing. You're still in the money. Let it go another 6 months. You're probably at the money. You have that time to figure things out. And that counsel, that advice from someone who is in the market is, of course, I'm inclined to say this given my role, but we really do add value in that regard. If someone's telling you have to do this right now, well, they're probably just out trying to make a fee. But if you really do have an advisor that's looking out for your best interest, they should know what those loan documents say, what the rest of the environment looks like, and able to advise you appropriately the path forward.
Yeah, then that's my one more tip. Call Steve Kundert. That's
the best tip I've heard.
Yeah, good on you with that advice. Yeah, I didn't think of that either. Where you're advising this person to do nothing, but that doesn't help you today. But giving good advice will help you long term. So that's good on you to do that. So great. Well, yeah, thanks for being on again. So how can people get in touch with you?
Yeah, if anyone wants to get a hold of me, you can feel free to reach me on email at steve.kundert, steve.kundert@cbre.com, or feel free to reach me on my cell phone, 312-213-8757.
All right, awesome. Thanks for being on.
Thank you for having me.
If you learned something from today's show, leave a review and hit that subscribe button wherever you enjoy your podcast. Dive deeper into real estate investing on Breneman Capital's website, breneman.com, where we have numerous free resources and information that can help both active and passive real estate investors. Accredited investors can get started today as a passive investor in our multifamily investment opportunities by hitting the Invest Now button on our website.
The views and opinions expressed in this podcast are those of Drew Breneman and guests as of the date of recording and do not purport to reflect the views or opinions of Breneman Capital LLC and its subsidiaries. Views and opinions are provided for informational purposes only and should not be relied upon or deemed as investment or tax advice or an offer to buy or sell securities. The speaker cannot be held responsible for any direct or incidental loss incurred by applying any of the information offered.